Okay. Hello, everybody. Welcome to our first webinar. I'm just sharing my screen. Good evening, everybody. Welcome to our first webinar. This is a Tinkerbell webinar. We're talking about the stock market, trading in the stock market. But first, I want to have a disclaimer. Please consider the information somehow confidential, which is like mostly company's material. And also, please consider this class or this webinar is not financial consultation or investment consultation. It is just for study and research purpose. Our platform is mostly for a study and research purpose currently, and we are not financial advisor. Very welcome to this webinar. And we will start this webinar with a short introduction that what you will see this webinar. We will discuss about the trading fundamental and advantage of the algorithm trading. We'll talk about the trading condition and trading triggers. We'll talk about and introduce our platform. Then we see that how is our platform is working. And for starting to using our platform, we're going back to see some of the very elementary indicators in the quantum analysis, EMA and MACD. And then we start building strategies on our platform. And then we'll have interactive algorithm building session together with you. And definitely we're here for any Q&A that you may have, and we'll answer all your questions. We try in this webinar that we have a little bit of the understanding of basics of the tradings, and then we'll discover the advantage of the algorithm trading, which we are promoting in our platform, and little bit learning about the quantum analysis indicators, EMA and MACD, and then we'll implement strategies with these two indicators in our platform. Let's go with the fundamentals. I know this part may be boring for some of you which are more advanced in the trading, and for you that have the financial background, but bear the situation with us because some of the participants are a starter, and we try to keep these webinars starting for the beginning of the algorithm trading, and then we will gradually bring more advanced topics to the table. Okay, we'll start with the most basic one, that what is trading and what we consider as a trading. Trading involves buyer and sellers financial instrument in various markets. So in the various markets, we have a buyer and seller, and they want to exchange their financial instruments. It serves as a mechanism for price discovery and liquidity. Let's look. What is the price discovery and liquidity? It has a two part. One is that the bid part, the other one is asking part. The price is a buyer are willing to pay is a bid, and the asking part is the price a seller willing to accept for that exchangeable. And discovery price is the price discovery is the process by which the highest bid, what the buyer are willing to pay, and the lowest ask, what the seller are willing to accept, interact and find the common ground and agreement, and the transaction is happening with that common ground. Sometimes it might not happen. One of the things about the trading that we try to find the balance price for exchangeable. Then we have a liquidity. What a liquidity means. It has easy and asset can be bought and sold without causing price changes. So it is the place that we are selling the asset without any changes on the price. And the stocks or exchangeable in general, they have a different liquidity level. Some of them has a high liquidity level, which it means asset trades in depth, active market with the tide, bids, and ask spirited. And so large order can be filled quickly at the price where close to the current quotation. It happens to the big stocks like Apple. We call them blue chips stock, and or like a large ETFs. Uh, so they have a high liquidity, and it is easy to liquid those exchangeables. But on the other hand, we have a low liquidity on exchangeables. For example, there are assets in the market with a wide spread and limit depth, meaning every modest order can move the price significantly. And for those type of a stock, that a small or even like a medium size order can change the price of those stock, or I can say exchangeables. And this is about the liquidity of the stock in the market. Let's go back to see that what is the element of the trading market. So we have the stock exchange, which is centric platforms like a New York Stock Exchange, like a NASDAQ, like a London Stock Exchange. And then we have the brokers. Brokers are the registered firm individuals that act as an intermediary for executing buy and sells order behalf of the clients. And then we have the retail investor, which mostly our platform, and I think most of the participants in this webinar, the retail investor, and the retail investor that who wants to do individual investment for personal gain. Some of them thinking long term, some of them thinking short term. Some of them are looking for the even high risk gains on their game. Then we have institutional traders like banks, hedge funds, and other organizations and large institutional with the large capital in their hands. Then on the other hand, we have regulatories. Regulatories try to regulate the trading and trading environment, and many more elements. And then I try to introduce the most important elements here in this webinar. Then we have the asset class. So we have a different asset class and different exchangeable. Stock is the thing that we are focused on it on our platform. And this is the first exchangeable we would like to talk about it. Then there are bonds, cash, currencies. Currency is different from the cash. The cash is the money that you are living with, and the currency is the foreign country's currency. Then we have the commodities like old gold and then agricultural products. And we have a derivatives, which are options and futures and the other items, which is a really big market, and it has also its own regulation. We didn't touch the derivatives yet in Tinkerbell, but this is the item that we will look into it in the future. Then also we have a real estate. This is one of the assets most of the family would like to have, direct property or REITs. And then we have alternative investment like a private equity, hedge funds, and infrastructure. And then we have a digital assets, cryptos and NFTs, which here in Tinkerbell, we're not looking now currently on these digital assets because of this volatility and also uncertainty, which is in the digital asset currently. Maybe in the future, we'll look into it with a more depth. Diversification benefits across different asset class. It's good to have a diversification. This is one of the topics, diversifying your asset class to eliminate risk. But when you are diversifying, each asset class has its own risk and return related to that asset, and also it has different market behaviors. Core market concepts, volatility, indicates the frequency and extent of the price fluctuation. And takeaway, understanding those concepts is crucial for time entering to the market and exiting decisions that we need to make it on different markets. We'll talk about the entering point and exiting point shortly in this webinar. Market structure, let's talk a little bit about the primary market and secondary market. Primary market is a place that all the exchangeable are exchanging. For example, the whole of the stock exchange on the New York is a primary market. We can see it most of the time online on the exchange platforms. But we also have the secondary market, which the investor are dealing behind the scenes without bringing those bunch of stocks onto the market. And it's those secondary market moving the market dramatically sometimes. Primary market helps companies to raise capital and the whole of the stock exchange, and secondary market provide liquidity and continuous pricing discovery for investor. As I said, this is the deals between investor behind the scene, and it happens behind the scene. Order type. Let's look at a little bit of the order type. We have the market order, executed immediately after the current market price, and limit order, execute only when the price reaches the specific level of the price. And then we have a stop loss order. We need a stop loss for risk management, automatically sell the asset when its price falls to the predetermined level, helping to limit losses. So we need it for a stop loss, and then we calculate that one. And then we try to set it up on the platform, and then having the stop loss across the platform. And then key consideration, choosing the right order type based on your trading strategy and risk management that needed to have a proper trading strategy. The rule of the market research and news. This part is very interesting. Definitely, this is the part most of the traders, even institutional traders, they stock into it because they need the information. They need to know what has been happened, what is going to be happen, and they make a decision based on the information. So what the people does, they coming and then they study the fundamentals, technical analysis, and then seeing the market from the different aspects and angles, try to understand that what is the dynamic of the market, try to understand the trends, and try to find the opportunity, and also understanding the potential risk, managing those risks, and having a very good deal in the market. This is what happened most of the time for any individual or an institutional trader. Then we have another aspect, which is the news, and which is the big nowadays, especially on the stock market. And these are the economic events, earning reports, geopolitical news, such as the tariff for the United States, which is affecting the market a few weeks back dramatically. And then these items is affecting the market. We know that, and the effect is inevitable. We have also blogs about that one, how deep might be the effect of the news to the market, and then how the people are following the market news, and what a pitfall the people would fall into it. You can see the blog on our website. The link is under the presentation. But what I want to say is that we have a hypothesis. We call it efficient market hypothesis. In efficient market hypothesis, we would say whatever happened in the world, whatever fundamental we have, whatever news is happening is affecting on the price and the chart. And then we can see the price is the reaction all the available information of that specific exchangeable. So there are theories that we can just look at the price and make a decision based on the price. And we don't care about all the other information, because the price is the projection of what has been happening and what is happening in the surrounding environment. There's a very good book, A Random Walk Down Wall Street. It has been published in 1972. Burton Gordon Malky. He is 92 years old now, and then he is a professor in Princeton University. He wrote this book a half a century back, and still the assumption that he mentioned in the book is valuable and it is valid now. And he brought this efficient market hypothesis to the picture, and I still believe it's part of the market and it shows the market behavior. And then we can see the market information just on the chart side and price side. Okay, challenge in the traditional trading. Let's see what a challenge we have. All of us, if we did a trade, we know those challenges. And if we didn't do the trades and we want to start a trade, on the first and second blog that you're reading about the trades, you would find these challenges. One of them is a slow execution speed, limited market access, high transaction costs, sometimes in the brokers, lack of real-time data, unclear trade costs, human error in communication, and many more difficulties. And there are pitfalls the traders are falling into, which mostly is connected to the emotions and feelings, like emotional decision making, a slowing reaction to the market movement, over trading, lack of consistency, limited time and attention, error in manual entering. And these are the pitfalls that any traders can fall into because we have a brain and the brain cannot function automatically all the time. And it's very hard to follow the logic. And then we are emotional endeavor, and it's very hard to control our emotion in the hard time, especially if you have a loss, you try to go back and then getting your loss back and try to overtrade, and then you are justify your decision, and then you see that your decision at the specific time was a wrong decision when you see the result. Okay, introduction to the algo trading. The algo trading, definitely it is faster for trading. It has a back testing. You can go in and checking what is the performance of your strategy, and handling a big data. Definitely you can handle the big data. You can do more trades with the less works. You just set up your condition of the trading. Consistency, you have the consistency. You don't interpretate on the information. You're sure those information is checking by machine, and then you're not, like the trader is not a person as an interpreter of the information. And it reduces the mistakes and many more advantages. But I like the three key benefits of algo trading, and I want to emphasize on those three. Like it is a scalable. It can scalable it, and it has a capability for a scalability. And you can run one algorithm, be sure that it's profitable, put it there, prepare another algorithm, be sure it is profitable, run it, and then another one and another one. And it gives a lot of capability to scaling up your trading. So definitely there's no emotion there in algorithm because you are not seeing individual loss or benefit that you have. It is not a gambling, and it takes you a little bit out emotionally to be connected with your strategies. And then you can make a more rational decision. And it works 24/7. You can build your algorithm, put it outside there, hope it works for you, and then you can sleep freely, and you can come back and see your trades and trades results, and many more definitely. But these are the main three key benefits of algo trading. Let's see trading condition and trade triggers. Let's look at that a little bit deeply. Before we start talking about the trading condition, let's look at the long position and the short position. We'll have a little bit overview of that one. I know some part of this is boring for the people who has the background and knowledge, and but it's good to go through the all the details, and we are ready to enter to the platform. Long position is that you buy first, hoping for the price will go up, then you sell to make a profit. And then you can see it on the chart. There's a stock, the stock is moving up. We hope that we can buy somewhere when the stock price is low, and then we hope for the movement to the bullish direction, and then we can get a profit out of it. And definitely we put a stop loss to not losing our money, and then we are securing our capital, and also we managing the risk that we can tolerate. Short trade. What is the short position? Short position, you sell first, hoping the price will go down, and then buy it back cheaper to make a profit. So here that you're selling your stock first, and then you hope the stock will go down. So you're shorting the stock, and then when it goes down, you take a profit, hopefully. And hopefully your analysis is correct, and this is a decision you're making. Definitely you put a stop loss for risk management. This is part of the game, and then you hope that you can take the profit at the end of the trade. And key trading conditions, definition of the market entering and exiting conditions. So the first thing that we do is that we define where to enter and where to exit from the market. Role of the price, volume, and volatility in decision making. Definitely, all those items is contributing to the decision making process we have. Risk management process. We do risk management in the trading, and important to have a clear definition and criteria. So you try to have a very clear definition of that, where you enter, where you exit, what is your risk management, what is your budget management, and how do you do your trades in general. These are the fundamentals of the trading. Because if you don't define it clearly, in the future you cannot go back to see what has been happened. You cannot go back to check your performance. Okay, set up trade triggers. For the long position, we open a position, we say buy a lower price. Then we have a close position, sell at a higher price, take a profit, target the price as above entering to take out your profit, and price below entry to limit your loss. And then you can set it up your stop loss. Setting up the stop loss is part of the budgetary and also risk management, which we don't touch it in this webinar. This is one of the items that we will talk about it in the future. Short position, open position at a higher price, close position at the lower price, and take a profit, target the price below entry that you can take out to your profit, because you know that the stock goes down, then you can take the profit that you are hoped for, and a stop loss, price above entering to limit your loss. As what we discussed, a stop loss is part of the budgetary and risk management, and we'll talk about it in the other webinar. Important to trade trigger, remove emotion from your trade, increase disciplines, manage risk efficiently. Risk management is super, super important, and supporting a strategy automation. And this is what we hope that we can achieve in Tinkerbell. Let's have a practical example of the trading. Let's look at one trade together here, and then we'll go to the platform and look at the trade on the platform. Long position, we're going to buy the Apple instrument, and market condition, that uptrend confirmation after a pullback. We hope that we have the market condition, which is the uptrend condition. We set a price for entering to the market with like a $171. Then we put our stop loss in 165. Here we don't discuss about the calculation of that, how we do the calculation. Now we just see an example, and then we take a profit in 185. Then we have a risk reward ratio. We can calculate the risk reward ratio, and we conduct the trade. Now let's go to the risk reward ratio. Let's a little bit touch the risk reward. Risk is how much you're willing to lose, and the reward is how much you aim to gain. Okay, I'm coming back here, and then you can see in our example that we have the risk. We are risking $6 here in our example, because we bought the stock in 171, we put our stop loss in 165, so $6 is on the risk, and we hope we can gain $14, which is we bought 171, and then we hope that we can sell it $185. So reward to the risk is 14 to 6. It is 1 to 2.3 dollar again. It means that when we get we're risking $1 to get $2.3 as a reward. This is the risk reward ratio we consider it for this specific trade. Okay, let's go. Trading principles, risk management, and the budgeting and budgetary are the future webinar subjects, futures webinar subjects. We're not covering all of them in the one webinar. It would be several webinars which we are touching the topics, and hope that you enjoy the future webinars. Building a strategy on our platform. Let's go to our platform and have a glance of our platform. Our platform is Tinkerbell.biz. You have the link of the platform on the LinkedIn. You can easily go to the platform. And then when you're going to the platform, you click on the sign in, and you're coming to the landing page. And by signing, you have the sign in window here. Then you can sign into the platform by Google account or Facebook account or LinkedIn account, sorry. And then when you are entering to the platform, you're going to Algo Builder page, or you can make the you can make a profile with your email address and also with your password. When you're coming here, you're coming to the Algo Builder page. In the Algo Builder page, in the main page, you can see the strategies that I tested in the past. When you're going there, you don't have any strategy. And if you want to start a strategy, you can start a new strategy in this place. Okay, I'm going to another account, because here in this account, I have the, like I performed the back testing in the past, and we can check the back testing that I did perform it in the past for saving time. When you're in the platform, that you can start with the new strategy, and then starting your strategy. As what I said at the start of the webinar, that we are going to check the EMA and MACD indicators. And here you can see we have a template of the strategies, and then you can start one EMA crossing for starting your first strategy. So you can use the template. Also, it is easy to add a condition, and then you can add the indicators. You can select among the indicators we have here. As what I said, we're going to check EMA and MACD as a starting point, but then here you can find another indicator that you may be familiar with and you would like to work with. And then adding the condition of those indicators. We have an AND condition and OR condition for opening position for technical analysis. And here we have our technical setup. If you're interested in a time-based condition, downside of the condition, you can find the time-based condition as well, and then you can set it up your time-based condition, which we are not talking about it in this webinar. We'll focus on the two indicators for starting the trading. And then if you don't want your in condition, you can delete your condition. As what I said, that we will start with a very simple strategy, which we're using the template EMA 50 and EMA 200, and we can prepare it. We can prepare the back testing setups, and we can test it for example, like a 2 weeks of a data, and see. I'm going back here. The interval between the aggregating information, I select the 5 minutes interval, and then I'm going for the back testing with the 5 minutes interval for 2 weeks, and then we can start testing. and it goes to the process. It takes a few seconds to do back testing, mostly now for the 5 minutes, because the number of the endpoint data that we have is large, and then it goes to do back testing, and then it will come back. But when you do the back testing, you can go back and then checking out the other back test or strategies that you have, then you can go back there to see your back testing. I'm coming back to the slide. I just want to introduce the platform. We're going to EMA and MACD, and then we're coming back to the platform, and we conduct a test for the EMA and MACD on the platform. Okay. Let's talk about EMA and MACD. I know this part is also boring for those who has the knowledge. We just touch it roughly here. There are blogs and articles in our website for more depth information, and also there are a lot of materials about especially these two indicators, because I would say they are a starting point for quantitative analysis. And this is a starting point. There is a lot of enough material about them, but how you can use it and how you can do the back testing, our platform is providing very good place and also computational power to do the back test. EMA is for trend following. It is a trend following indicator that gives more weight to recent price, and MACD is a momentum plus trend indicator, which it shows the momentum and also indication of the trends, and showing the relation between two EMA. Actually, it used two EMAs, combining them, and usually like a EMA 12 and EMA 26 to give information, like combining the information in one place, and then try to give idea to trader that what is the momentum and what is the trend on the exchangeable. The formula of the EMA, just roughly go through it. The EMA of the time is calculated with the EMA of one period back of that one, EMA value at the time t, and then we have the price of at the time t multiple to the cofactor, which is a smoothing factor, which is the smoothing factor is correlated to the number of the period, and then we calculate the EMA for a specific time with the smoothing factor we have. On the example that we saw it, the smoothing factor and the number of the periods that we are looking to is the 50 and 200. And now we are also talking about it here as well. Role of the EMA in the trending analysis. Let's see what the EMA can provide for us. What information we have in EMA. Identify market direction. When the price is above the EMA, the trend is often bullish. So when the market price is more than EMA, most of the time it's bullish. When the price is below the EMA, the trend is often bearish. Confirm the trend. We can confirm the trend with the EMA. A slope EMA suggests a strong trend. A flat EMA suggests a sideways and a weak movement. It's also filter the noise, those small, like those big spark and then surges in the price. It's smoothing all of that one. And EMA smooth out short-term prices, fluctuation, helping traders focus on the overall trends and see the big picture of the stock. And it's also EMA gives the dynamic support and resistance, and price after bonuses of the EMA is a trend acting as a support in uptrend and resistance in a downtrend. So we have the dynamic support and resistance for the price. And then how we are using that, or how we are using EMA. Most of the time we use crossover strategies. And for example, we look at the short EMA, which is, for example, 50 EMA. When the short EMA cross above the long EMA, which is 200 in this example. Then we said that we have a bullish signal, and we call it golden crossing. On the other hand, when we have a 50 EMA cross down the 200 EMA, we said, okay, this is a bearish signal, and this is a dead crossing for us. And we use this condition in our platform now to see that how the trade can be happen with the EMA. I'm going back to the platform. I'm going back to see that what happened to our test. Uh, Let me start a new strategy that you can see how am I starting a new strategy for EMA crossing. I don't use the um, template, and I want to just start it from scratch. Okay, first I'm changing the name, EMA crossing. Then you can choose the instrument that you want to trade. Let us stick with the Apple, which comes on the top of the our list. Then long position as what we want. Let's go for 5 minutes intervals. Let's have a bigger budget. We'll go to the $10,000 for our budget. And coming back here, we want to test EMA, and we want to EMA 50. And we said that when the EMA 50 cross over EMA 200, this is the point that we have an open position signal. We said that it is indicating the bearish condition. Set it up, open position condition. I'm going to the close condition, and on close conditions at EMA 50. Now this time is smaller than EMA 200. And then we are ready with the conditions. We have the open close condition. We didn't set up a stop loss. We didn't set up the take profit. As what we discussed, stop loss especially is part of the budgetary. So we didn't set up anything for that one. We said, okay, if it is just we take the profit here, and if it is like profitable, we're moving forward. In the future, we'll talk about the stop loss. We do the calculation on that, and then we'll have a more clear picture about a stop loss. Now I'm going to select 2 weeks for our back testing, and then let's do the back testing on these conditions. And as I said, it takes a few seconds to do the back test on the cloud, on our computer. And this is the power of what we have is you don't use any computational power of your system or your computer, and then you can do the back test on the cloud. And then if it takes time, you can go back to strategy. You can check out the other strategy, which we did a back test in the past. And then you can see on the back test that we did it in the past, we have the report of the back test, and we got a 5% profit on this one. So it seems we are lucky with the first initial trades that we did it with initial stock, that we got this 5% profit. Now you can see the details of each trades that it has been happened, and then what was the profit and loss for the trades. And what I see is that we were lucky in a few of the trades. Like we have 2 big trades that we were lucky with, and those 2 big one is helping us to having profitable platform. But it's very risky because we lost in a lot of the trades that we did in this strategy, and it's not, to be honest, it's not a good strategy in general. But at the end of the day, it was profitable for this specific stock. I'm going back to the strategy we started, and I see that this strategy also the backtest has been completed, and then we got the result, and it is the same result as we saw it on the other backtest. So this is for EMA. We prepared the condition, we did the backtest, now we come back. Let's move forward to the next indicator. Next indicator. MACD. Okay, you, as I said, most of you are familiar with the MACD and used the MACD in the past. Uh, let's look at the MACD formula. For example, we have the MACD of the 12 and 26 as usual, but these parameters are settable. We have the MACD line. The MACD line is calculated based on the EMA of the 12 minus EMA of 26. We want to see what is the MACD line. Then we have the signal line, which following the MACD, it's smoothing the MACD. So signal line is EMA 9 of the MACD line, and we use the same EMA. So we are like using two EMA, deducting them, we come bring it back, and then using another EMA to smoothing that MACD line. And then when we have this information, we are drawing a histogram, which is the MACD line minus signal line. And this shows our histogram. Representing the momentum, positive when the MACD is above the signal and negative when the MACD is below the signal. Let's go. We can see it better on the graph. We have a graph and then we have a better representation on the graph. Role of MACD in the trading analysis. Before the graph, let's see the role of MACD. Identify the trend direction. When the MACD line is above the signal line, it signals a bullish trend. When the MACD line is below signal line, it suggests a bearish trend. And so we can understand that like we can get a signal of the bullish trend and bearish trend with the MACD. Measuring momentum strength, a widening gap between the MACD and signal line means a strong momentum in the trend, and a narrowing gap crossing signal weakening and momentum or a potential reversal. So when the gap is closing, there is a momentum for reversing the potential for the trend. Bullish crossing, trend reversal signal is a bullish crossing. MACD crosses above signal line. We have the bullish crossing. We use this one for entering to the trade. And then we have a bearish crossover. MACD crosses below signal, and it's possible down trading. It is showing the down trend on a stock. Then zero line crossover, MACD crosses above the zero, and momentum shifting, it is bullish shifting, and MACD crossing below zero, momentum shifting is a bearish shifting. Let's go and then see it on the chart. When we have the graph, it's more visible. Here is the candlestick chart of the stock. Hope most of you are familiar with the candlestick chart. And then you can see the calculation of the MACD under this chart. The MACD line is always moving forward, and the MACD line is moving forward, and the signal line is smoothing the MACD line. In this example, the MACD line is the gray one, and the signal line is purple one. And you can see the MACD line is moving up and down, and the signal line is following the MACD line with the smoothing of the MACD line. And then we have the histogram, which shows the gap between MACD line and signal line. And when the MACD line and signal line are crossing, this is the time that the histogram is zero. And this is the time that we have a zero number on the histogram. And when there is a big gap between MACD and signal line, then we have a bigger histogram, and the histogram shows bigger number. But when they are going to be close to each other, the histogram is going to be close. And you can see here the bullish crossing. It means the MACD is crossing the signal line. The MACD goes up, signal line trying to get it. So this is the bullish signal. Then a strong upward momentum because we have a big histograms. Then bearish crossing, MACD is crossing down the signal line, a strong downward momentum because we have a big histogram that which shows the now there is a big momentum on the bearish side, and then another bullish crossing, and then it's moving forward on the MACD graph. Go back to our platform, see that how we are implementing the MACD. I'm coming back here as what I said. So let us start another new strategy. As we have this time, I'm using the template because it would be faster, and I'm moving the EMA on our template because we just want to work with the MACD. We said MACD line is bigger than signal line. When the MACD is crossing the signal line, so this is the signal for bullish market. When we have the bullish market, which we didn't talk about that definition, bullish and bearish market. So it means the market is going up. This is a good time to open a position. And then when we have the MACD line is crossing down the signal line, it's good to close our condition. Now we have open condition and close condition. Let me remove the stop loss as what we discussed. We then set up the stop loss, and then we want to do back test for this condition. Let's back test it again with the same condition, 5 minutes, $10,000, and go back for 2 weeks of the back test and see the result. As I said, it takes a few seconds to do the back test because of the number of the endpoints. And I set up this one in the past, and then we can see the result here. MACD one condition. Let's see what happened there. We had the MACD. It is with the Apple, and on that MACD, oh, this is short, but we're looking for a long. This is not the same as what we had. So I'm going back again, seeing that what happened with our test. It takes a few seconds to perform. Let me see. Yeah, I think I have MACD, solo MACD here. Yeah, solo MACD here. The same condition. It was long. We tested in the past, and you can see that the result of the test. We did 11 trades in this test. Going back, some of them are successful, 4 of them are successful, and a lot of unsuccessful trades. But at the end of the day, we got a 2% profit on this strategy. Not bad. It's bad actually because we lost more than what we gained in the number of the trades, and but this is good with the one condition. Still, we are positive with the one condition with the first stock. Okay, so I'm coming back to the presentation, and let's move forward. I want to give you a chance to start working in our platform and also going for a Q&A. And let me move a little bit faster. Now we are combining EM and MACD together. Now we want to have a long position with the combination of these two strategies. We said we have a long position. We set up EMA and MACD strategy. EMA condition for the long position. EMA 50 with the with crossing over the EMA 200. The same condition, and for the MACD, for confirmation of our condition, MACD line crossing above the signal line. And for closing of the combination of these two indicator, that we use MACD line crossing below signal line, and now we don't have an and condition, we have or condition. EMA crossing below EMA crossing, EMA 50 crossing below EMA 200 crossing for confirmation of closing of the trade. Let's go to our platform. And here, let's see how we can have the combination of the two indicators. Let me use the combination that here we have it here. It's faster. We set EMA 250 bigger than EMA 200, the first condition. MACD line bigger than MACD signal line, the second condition with the MACD. Here for the closing of the position, EMA 50 smaller than EMA 200, but for the MACD, it should be OR condition. I'm deleting this one. I'm going to open OR condition. So we set MACD, and we want the MACD line. Sorry, make it smaller. MACD, so MACD line. Save it. Is we set MACD line smaller than signal line. Saved. Let's remove the 2% of the stop loss. We had this as a default here. I removed it because we didn't discuss about the stop loss, and then let backtest it. Let backtest it for a shorter time, for 1 week, because we have a lower number of the endpoint for file. Sorry, okay, this is not 5 minutes. I change it to the 5 minutes. It has a more endpoint number, but it gives us more trades. And somehow, but because it is the number of the endpoints are higher, so it would be slower in the back test. Let's go for the back test and see what it will give to us this condition. And what is the result of this condition? Okay, it takes a few seconds. In meanwhile, to come back, I just want to check another strategy. You remember we had the MACD and MACD, and then we tried it for the Apple, and we just let them test run, and we can see the result of the back test for 2 weeks, the duration of that, and then we had a tremendous amount of the profit here with the 62 trades. The number of trades is significant, and yeah, then you can see the results, the detail of the results here. Okay, in some periods we have a very good number of the results. Okay, I'm going back to see this last back test that we had. I'm going back to strategies. The last one we had it here. Going back here, refresh the points. Okay, it takes time actually. And let me show you one of the EMA and MACD fusion that we did it in the past, and the result of the EMA and MACD fusion. This is the same. You can see it here. Opening position, we have the same two conditions for that one, and closing position, we have a one EMA position, EMA condition on the top, and then MACD condition as the OR on down of that one, and then we can see the result of the back test. This one also was Apple instrument, and 5 minutes, and we did the same for the same instrument. And I'm just going back to the backtest results, some of the backtest results. I want to show you that you can change your instruments, and a few of them has a different, for example, this one. Yeah, we tried it with the Amazon, then with the Amazon, we lost a little bit of the, with the same strategy, we lost. Then we're going back and we tested with Boeing instrument, and with Boeing instrument it was profitable, 12% profitable, the same strategy, and we just changed the instrument to the Apple, and it is 8% profitable with the Apple. And it shows that when you have the strategy doesn't work for all stocks. They have a different behavior in different time periods. And then you have the chance to do the back test and check it out, that different behavior on Tinkerbell platform currently. Okay, that's very good until now. and we are ready that start to you start a session in the platform and open it up our platform. And if you would like, you can make a strategy in the platform and start your experience in the Tinkerbell platform. And I'm ready for any question. If you have any question, please come over and tell your question. Then I try to help to answer the question. Thank you so much for the time, and I'm here for the questions. Okay, it seems there is no question. Nobody raised any question, which is good in somehow. And so if you don't have any question, I encourage you to open the platform and work with the platform and try to test your knowledge inside the platform. And good luck in your journey to be trader. It's very hard. I don't recommend anybody to become trader, but I recommend you to expand your knowledge on the stock market and then what is the dynamic of the exchangeables, and our website and platform is a good place to you expanding your knowledge and expanding your experience without losing money. If you don't have any question, I want to say goodbye to you and have a good evening, and also have a good week ahead. Have a good day. Bye. Bye bye.
Thank you very much.